In November 2015, the FASB issued Accounting Standards Update 2015-17 as part of the FASB Simplification Initiative. The ASU is intended to reduce costs and complexity related to the balance sheet classification of deferred taxes for entities with a classified balance sheet. Welcome to KPMG Podcast on ASU 2015-17, Balance Sheet Classification of Deferred Taxes. My name is Todd Raven, and I am joined by Damon Romano, and we are both senior managers in KPMG's Department of Professional Practice. During this podcast, we will provide some background and an overview of this new standard. So, Damon, before we begin, maybe you can clarify whether this ASU addresses the accounting for deferred taxes or just the presentation.
Great question, Todd. This standard only addresses the financial statement classification of deferred taxes for those entities with a classified balance sheet. It does not impact the accounting for or the disclosures related to income taxes.
All right, thanks for clarifying. Could you provide us with a brief background of this new standard and why the FASB considered this?
Sure, no problem, Todd. Under current guidance, an entity that issues a classified balance sheet presents a net current and a net non-current deferred tax asset or liability for each jurisdiction. Normally, this classification of current versus non-current is based on the classification of the underlying asset or liability. For those deferred tax assets or liabilities that are not related to assets or liability recognized under U.S. GAAP, an entity would classify the deferred based on the expected reversal date of a temporary difference. A common example of this is the deferred asset relating to a net operating loss carryforward. In addition, if an entity required a valuation allowance, the entity was required to allocate the valuation allowance among the tax-paying jurisdictions and separate them between current and non-current deferred tax assets on a pro rata basis. Financial statement preparers told the board that complying with the guidance was just too costly. In addition, stakeholders thought the classification of the taxes was confusing and provided little benefit since the classification may not be consistent with the expected recovery or settlement timeframe. Based on this feedback, the board agreed and developed this new model that will help reduce the costs and complexity, but will also maintain the usefulness.
Oh, thank you. So maybe you could just walk us through the new model that the FASB introduced.
Sure, no problem. As you mentioned at the beginning, this ASU was issued as part of the Simplification Initiative. The ASU will maintain the requirement for an entity to offset all deferred tax assets and liabilities, and of course any valuation allowance, for each tax-paying jurisdiction within each tax-paying component. Now, instead of looking at the underlying asset or liability for classification purposes, an entity will report these net deferred tax assets or liabilities as a non-current amount. One thing I think is important to point out was that the board acknowledged that classifying all deferred tax assets and liabilities as non-current is not going to be consistent with the principles of a classified balance sheet, considering that some deferred taxes will reverse within 12 months. The board did consider an alternative that would have required entities to estimate the timing of the reversals of the temporary differences and classify them based on this, but determined this option was not practical and would introduce more cost and complexity as compared to the current requirements.
That's very helpful, thanks. I think it's probably important to point out that entities need to consider the impacts of this ASU on certain ratios like a current ratio. Once this ASU is adopted, entities with large current deferred taxes may experience a pretty large decrease in their current ratio as a result. These entities should carefully review debt covenants to make sure they are not impacted, as well as educate stakeholders about the change. Can you walk us through the effective date and transition?
Sure, no problem, Todd. For public business entities, the ASU is effective for annual periods beginning after December 15th, 2016, and the interim periods within those years. So for a calendar year company, it would be effective for the 2017 fiscal year. For all other entities, the ASU is effective for annual periods beginning after December 15, 2017, and the interim periods in the following year. Early adoption is permitted for this ASU, and in addition, this can be adopted either retrospectively or prospectively. If adopted retrospectively, the entity will be required to disclose the nature and reason for the change and quantitative information about the effect of the accounting change on prior periods. If adopted prospectively, the entity will be required to disclose the nature and reason for the change and a statement indicating the prior periods were not adjusted.
Thank you very much. One question regarding early adoption. Could a calendar year-end entity adopt this in Q4 of 2015, or must they wait until the beginning of a new fiscal year?
Todd, that's actually a question that we received from quite a few people. Per the guidance, the ASU can be adopted as of the beginning of any interim or annual reporting period. So in this case, if the Q4 financials have not been issued, a company could adopt during this period.
Thank you for clarifying. So for those entities that are considering adopting retrospectively for their 2015 year ends, they'll need to revise the prior years presented. Thanks, Damon, for walking us through this. And for more information on ASU 2015-17, please refer to our Defining Issues publication, which summarizes the ASU. The Defining Issues and others are available for download at KPMG's Financial Reporting Network. Thank you for listening.